Thanks for tuning in to BQ Conversations on BloombergQuint. One of the oldest private media houses has announced their intent, or at least the promoters have announced their intent to sell up to 50% of their stake to a global strategic partner. There's lots that's happening on the distribution space as well. To make sense of all of this and the changes in the media space, let's get in a very special guest, Mr. Ronnie Screwvala, a media veteran, entrepreneur, philanthropist, joins us right now on the show. Mr. Screwvala, thanks so much for taking the time out and speaking to us. I'm starting off with the news at hand, and which is the Zee Promoters' intention to go out and sell 50% of their stake to get in a global strategic partner. How did you read into this news? Is this a sign of the promoters wanting to exit their business slowly, or is it a recognition that inherently they might be incapable of battling the larger media giants and therefore the need to get in a stronger and a global partner?
Well, you know, when I look at advancements, I look at things as opportunities. I don't look at the negative context of it. So I don't see this necessarily as something which is an intent to exit, and I don't see this as something which puts them in an incapable position. Personally, my sense of the promoters is, as you've rightly described them in the beginning, they've been pioneers. They're 5 steps ahead. They've understood trends. They've built a sort of an integrated and multimedia business. And I think from that perspective, when you look at trends and when you look at crossroads, your ability to preempt the next trend and figuring out your strengths and weaknesses is a good time for you to re-evaluate exactly what you're looking at doing. So I think for them, their perspective, they're not just a broadcaster, they're not just a content supplier. I think they have built a multimedia business, and if you look at the divergence in which they do that from the element of content to the element of platforms, and now multiple platforms, because I think even their Z5, they've been able to scale it. The crossroad I think it is at is now, given the other companies that are coming into the fray and the way audiences are consuming everything else. So I think what Subhashji and the team there and the founder promoters are rightly looking at is, we can look at it as a business, but at the end of the day, how is the consumer looking at it? And I think the shift that he's seeing is, how is the consumer, who is my consumer, how is my consumer going to consume, and what is he looking at it? And if I don't preempt that change, I could be an anachronism.
Interesting. Okay, I mean, there is, of course, if I look at the research reports that came out, and people who track the stock per se have spoken about how there could have been other reason of business compulsions and other businesses too, but I won't get into that with you. My question to you would more largely be that from a perspective of somebody who's built such businesses as well in the past, is the tide looking favorable enough for somebody and such a large media house to get in more funds, yes, but keep their shareholding in this business intact, versus stating an intent of liquidating 50% of their holding in that particular business? That's the dichotomy, I think, in the minds of people, that if indeed the business was looking so favorable, why liquidate only their stake? Why not get fresh funds into the business?
You know, I think this is an age-old thing which only comes up in India. The minute you're sort of not 100% owner, you are already working at it on a largest framework. The minute you're not a 51%. So I think this control context in India is sort of over-dramatized. I think to answer your question sort of very directly, I think the fact is they can raise money at the company level, or they can raise money at the holding level. I think the context for them is really, what is somebody going to be able to bring to the table along with them to take it to the next level. And I think the question of today, I think, given the competitive environment, yes, I think it is the question of how the audience is going to look at this. What do I need to do? Is the investment in technology, is the investment in content, is the investment in customer acquisition? I think what the asset base here for a media company like Zee is really their footprint and their footfalls, as I would put it. Their connectivity with the audience, the brand recall, their access and ability for that kind of viewership, and the mind share of audiences. If you take all of that, that's a substantial asset. Now, I think it's up to the founder group to figure out that, do I want to look at this as I'm fine to be a 20% shareholder instead of a 40% shareholder? Because I think today, if you look at it, most growth at scale is going to happen through collaboration and not necessarily on a competitive basis. Now, there'll always be those massively huge companies that will say, winner takes it all, or kill the competition and that's the way I'm going to grow. But for most other companies, I think it's going to be a much more an era for the next 10 to 15 years of collaboration more than even consolidation, because consolidation sometimes is, two and two coming together, and many times it becomes three, it doesn't even become six, because there's erosion between culture clashes, assets, why the two companies ever got together, and sometimes it even comes to a three. But collaborativeness, I think, will ensure that 2 plus 2 is much more than 4.
They are very well known, Mr. Screwvala, as content providers who actually make content at a fairly economical cost as well. Zee is. I was speaking to Sameer Nair a couple of quarters ago, and to his mind, the discovery of content with all of these platforms throwing up content at the rate of zillions is the biggest challenge. Do you think any media house in India currently needs to have a partner which enables them to, one, reach more people and then to have their content discovered well? And would that be the kind of partner that a house like Zee would be looking for as well? I mean, I'm just asking you to put yourself in Subhash Chandra's shoes, because you've built such businesses in the past.
And I would say no, because the simple reason is it's not everything is a content play, but this is not much more about how do I get somebody to collaborate to figure out content. In fact, I think most multinationals have struggled with a sort of a culture and a context of India to localize. And I think Zee's cracked it, not just in terms of economics, but just in terms of the reach and understanding the consumer. So it's much more, what is the consumption pattern of even content? So I think the partnership there is going to be much more about technology, deeper understanding of the consumer and the audience, how to mine data, because actually the biggest things that are happening with the social media companies or the Apples or the Facebooks of the world today is exactly how they look at data and how they mine that. Those are things you can say, I'll bring in people and I can start it as a division, or I can just leapfrog and say, even if I do it for the next 5 years, I'll be able to get to this level. But if I bring somebody in and the 2 plus 2 becomes much more, I can leapfrog. And I think it also has to do with a lot of the competitive environment that's coming in here, right? Because you have a consolidation with Disney and Fox, which in India means Disney and Star. You have on one side Jio, which is no longer a telco company, and is a sort of not even a multimedia company in many aspects. And between them and the media assets they already own with an equally robust competitive network, you need to look at that landscape also and say, how am I going to be 3 steps ahead of what could be a competitive environment in any case?
Very interesting. So if you were in that shoes right now, Mr. Screwvala, what do you reckon the biggest need for a content provider like Zee or any other provider would be? I know you mentioned that it won't be just a content play, it would well be a technological play, but there are a bunch of global media houses or global companies which have now shown interest, and a bunch of those which don't have the assets that their competitors have. I mean, Jio has some, Amazon has this video content, but a Walmart, Flipkart or an Airtel, which is an Indian entity, yes, doesn't quite have the content edge that their competitors have. Is that a good marriage, you reckon?
I think when you look at marriage and when you look at the strategy part, there are a couple of things. One, if the present founders of Zee are looking at this much more as a liquidity event along with strategy, then there's a different incumbent. For businesses and at scale for investments to come in here, there needs to be something very strong for the incumbent to come in. India is one of the largest markets, but at the same time, they know it's a big barrier to break into. So that's a big threshold. China, if you look at it from this market, is pretty much closed. It's very insulated and actually closed and unwelcome for anyone outside of China to be able to come in there. So therefore, India is a massive bastion. So I think first and foremost, it's going to be what is the interest, because with almost all the candidates that you mentioned, from Amazon is substantially a commerce play, and I think for them, even if you look at Amazon Prime today, primarily it is same-day delivery. If you ask 9 out of 10 consumers today, it's the same-day delivery process, and content is the bonus. So I think you'll have to look at what is the strategy of somebody coming in. Multiple media companies from Time Warner and many others have tried to come into India twice, thrice, 4 times, failed, retreated. And that's been expensive learning lessons for them. Today, I think the need is much more the marriage of technology, data, and a deeper understanding of the consumer and the audience. To that, if you marry content prowess, the eyeballs that Zee has, the brand and the reach that it already has here and in the diaspora of about 30 to 40 million globally outside of India, and you look at that connect, to me, that's where the fit really comes in. And obviously, with that comes deep pockets. People are looking at funding it for $1 billion, $2 billion, whatever the case may be, because if it's $50 million, $100 million, $200 million, I don't think anyone's doing any transaction here or moving any needle anymore.
Yeah, but you reckon that for an asset like Zee, and you mentioned twice in these last two answers a deeper understanding for the consumer or the viewer in India, and I believe Zee has that, and how. Do you believe there will be a case of a lot of people wanting a strategic pie at the 20% that Zee offers or has put on offer?
Yeah, I would say so. And I think after that, you have to see how that goes and what would happen for that. I mean, whenever an investor come in, he may think 20% is a good entry point, and then he may look to expand as far as that is concerned. But that'll be more with the incoming investor. But I think the foothold is going to be quite important. I do agree that for somebody wanting to look at it strategically, overall 20% of an entire company may not be the most appetizing, but it's a good entry point.
Interesting. Mr. Screwvala, how do you view the space going ahead? Now, Zee's been a master of sorts, and their numbers have shown it over the years that the content that they produce and the way they distribute it, they're able to earn the money, which is not quite the way some of the latest OTT or digital media platforms are being able to do. The content is well appreciated. Somehow it's not getting monetized in the way and at the pace that people or businessmen would like. How do you think the next 5 years shape up? And then, therefore, for a platform like Zee, which is now going to get a strategic global partner as well?
I guess that's been the quintessential problem of India, where monetization has been a huge challenge. Monetization for a consumer paying and the subscription base. If we had a subscription given culture where people could charge, the entire economics of the media industry would be a minimum of 10 times of what it is today, because we wouldn't be so advertising dependent. And that's the economics that has driven most of the conventional media part, which is the advertising part, barring sort of the film industry and the music industry on the flanking sides. Radio, broadcasting, television, and everything to do with that has been substantively advertising driven. Over the last 4 or 5 years, with the advent of DTH, I think that has changed there. Cable has always struggled in terms of neither scalability nor monetization. I think the unfortunate part today is that here we found that digital offering could be that new element by which you can get the consumer to pay. And that's also challenging, because you have premium players like Netflix who may rightly feel we want a universal pricing around the world. It makes sense for them. So they'd rather take the top of the pyramid and build on that slowly and take a longer view than drop the rates. But then you've got a magical player like Jio, for example, who can look at bandwidth as a commodity and then look at all the frills that come with it. And then when you bundle and package it at the depth of 200 million, the main thing most people challenge with, even when you're looking at a DTH player, is they've been managed to go from 4 million to 20 million, 30 million subscribers. But when you get to 200 million going to 400 million, that's the time where economies of scale can play in a country like India, where there's always a threshold of what the consumer will finally pay. I think the few exceptions that are coming about today, and in this whole media landscape, we need to talk about sports, because I think that in a form comes into the entire media and entertainment landscape completely, and it's an expensive category now. And Zee has gone through that. They've had 10 sports and then they've divested 10 sports because they felt either it's going to move the needle or let me get out of that thought process, and rightly so. They took a strategic step that says, if I can't be a leader, might as well step out of that. So that's deep pockets also. And I think over the next 5 years, you're going to find audiences and the trend for consumption of sporting events, not just cricket. Otherwise, most people ever thought sport was cricket, is also going to expand. That's going to need deep pockets. But it's also going to require unconventional media platforms in which you're going to be able to consume multiple sporting events. Today it's cricket. It's already emerging in football and kabaddi. There'll be at least 3 more. You'll have 5 sort of national sports in the next 5 years with high ranking and high value propositions. So that's one ecosystem also where I think you'll find the base broadening.
Interesting. You've built successful businesses and then divested them as well in the past 10 years that I've read about you and known you in that sense. If you were to be putting in fresh money to work right now from a perspective of an investor and not necessarily only an entrepreneur. Where would you find favor, Mr. Screwvala? Where are you seeing prospects for monetizable growth? I know you mentioned sports, but I think it's difficult to figure out which brand, which platform will be able to do that right now as we speak. Where do you think people will be able to make or monetize money?
If you're asking me investment opportunities specifically in media,
yes.
Yeah, well, look, I think that's a tough space. And the reason it's tough when you're looking at, because if you don't have a substantive amount to invest, then you're pretty much going to be marginalized. I mean, even now, the new digital players that are coming into the market, they're already three behemoths in a different sector. You already got the established media companies that have got offshoots of that. Then you've got all the social media companies that are looking at this as an extension. Then you've got all the telcos that are looking at this as a brand extension and a way of monetization. And then you've got global players like Netflix, Amazon, Hulu that are going to be in the play. So with that, there isn't that much of scope for what I would call individual investments today, which is why I think most companies are either looking today in media as to what's the crossroad. You can always remain someone in a niche business or a family business where that's not going to be questioned. But if you're already in the multi-billion, and if you're a 4 to 5 billion value business, and you now need to figure out either that 5 billion is going to stay static at 5 billion, or it might come down to 4 as the competition goes. But how do I take 5 to 15 billion? And the point is, so what if I don't own 40%, but I own 20% of a $20 billion company versus 40% of a $5 billion company that could drop to 4 billion or 3.5 billion with competitive pressure? That's really the core and decision. But I think from an investment opportunity, if there's not deep pockets and scalable ones, there isn't that much really to really dabble on. Content per se will always remain a very fragmented industry because it's a creative driven process. It is to quite an extent individual driven. You can corporatize it to a certain level and then you can scale it, but it's always a B2B business because if you're only in the content business, you're subservient on multiple other platforms in which you can do that. So there's a limit to what you can scale. So I think it's only really about deep pockets. So there are very few Indian companies now with that deep pockets. And then you have global players looking at this vast market called India.
Yeah, okay. Last couple of questions. The more things change, Mr. Screwvala, the more they remain the same. Would you believe that storytelling in India would need to change? Because hitherto we've been a country of content providers who are largely making daily soaps, 1 hour videos that are told, or 1 hour content that is told almost every single day, 5 days a week. Now we have the advent of Netflix and Amazon Prime, which to a person like me in an echo chamber like Mumbai seems to be doing very well, but don't quite know the pulse of India. What do you think happens to a content player like Zee or a Star or somebody else over the next 5 years?
So I think, and I'll answer the last part of your question separately, but I'm a firm believer in and versus or, especially in the segment of storytelling, audience reaction, audience consumption patterns, and media overall. It's about the and. So it's not about a knack of storytelling that's going to replace anything else. It's the fact that if for daily soaps, which is the staple plate, and that appeals to about 250 to 300 million people of your core audience, that's not going away in a hurry for a fair period of time. But what is happening is every year, 20 or 30 million people are moving out with fatigue on that, either that or consumption patterns, or are not looking at television, and therefore need to see it either on a different platform or culturally have moved forward. But there's a new ground of another 10 to 20 million people in a country like India that's always coming in. The people who've in some form become more aware, have become accessible, have entered the lower middle class level can now access that. So that trough of that, what I would call middle common denominator, will always stay there. So now you've got the millennium segment and the early millennium, and even now that's going to get redefined, and the people who drop out. And that's really, today in any other country they would be called niches. But here, they can be 10 million, 20 million, 30 million, and 10, 30, 20, 30 million in a country is almost 100% penetration of that market. So those are large niches for people to follow. And I think that's where it's going. So specifically, it's about an and not an or. I don't think we're going to find replacements as much as we're going to find a broader base of consumption, broader base of different storytellings, because otherwise, till 5 years back, when you're talking about that change, most storytelling was to the largest common denominator and on a common platform from television where you couldn't experiment and say that from 7 to 10 I'll tell you these stories, but after 10 I'll tell you those stories, because you couldn't find that niche. Which is why the 5 mainstay genre entertainment channels, when they had the soaps that were working, it was a damned if you do and damned if you don't, in that you can't replace them. So then they would start the flanking channel. So everyone had a flanking channel and a separate channel that almost addressed a new audience. And then they realized that actually those audiences were moving out of television viewership totally, and they now had to find them on a different medium or platform. So, and to answer the last part of your question of therefore what do players like Zee, Sony, Viacom, and many others do, and I think to that extent they are addressing that, because I think if you look at Star's flag bearer, it's really Hotstar, and if you look at them and what gets the buzz there, there's a lot more focus on the digital medium, not necessarily in content. You'll add 5 more channels to your bouquet. You already got 55 channels or 100 channels, you're going to add 5 more. That's not going to move the needle. HD versions of them, or a plus here or a plus there, is not going to move it. And I think people are looking at that. So the last 2 years, the focus has been how to broaden the base, which means look at music, movies, and all the other complementary services, and how to look at the digital platforms.
Interesting. And lastly, so you reckon that in more ways than one, Zee's attempt, even though there might be other reasons to it, and we can't really guesstimate that, but Zee's attempt is to attract a partner on an equal footing to be able to do all of that and more.
I would think so. I think that's what I hear. I mean, if somebody asks a founder a baited question that, oh, if somebody cuts you a check that you can't, makes you an offer you can't refuse, well, what do you expect anyone to say other than say, if somebody makes me an offer I can't refuse, you've already answered my question because you've already told me that I can't refuse it. So that's a sort of a rhetoric question, and I don't think we should read too much into that.
No, but in this case, nobody's cut a check as yet. They are actually going out and seeking a check, and only for their stake, not for a company-wide dilution as whole.
Yes, yes. Yes, but I think the advent of a partner coming in there, and I'm not here to sort of speculate or figure that out, but I think there would be 2 things here. One is, yes, I think at this stage, I don't want to get into a dilution mode. I do want somebody to come in and for me to share that burden and that risk, one. And then things will unfold for that, because anyone who owns 20% of a company may then decide he may want to do anything with that company after that. So I think it makes total sense, rather than just going out and raising funds, which also makes sense, but it's a different strategy. And that I think is from promoter to promoter and from opportunity to opportunity, because I think full marks to them if they can find somebody who wants to come in more paying secondary than a primary offering.
Interesting. Interesting thoughts. Thank you so much, Mr. Screwvala, for throwing light on that, as also your views on the media space at large. Really appreciate your time.